A company just locked in $2.8 billion in multi-year AI cloud deals with the biggest names on the planet, Microsoft, Nvidia, and Perplexity. That same company just raised its annualized revenue target to over $4 billion. So naturally, the stock is exploding to all-time highs, right? Wrong. Over the last month, IREN didn't rally, it collapsed, plunging more than 43%, cratering from the mid-70s all the way down to the low 30s. And that one contradiction is exactly why I made this video. Because there's a single announcement buried inside this story that could flip the entire narrative overnight, and almost nobody is talking about it yet. At first glance, none of this makes sense. A company practically printing future cash flows shouldn't shed nearly half its value in a matter of weeks. But when you dig into the numbers, you uncover something wild. A multi-billion-dollar execution gap, a controversial CEO pay package that has short sellers circling like sharks, and a powder keg of short interest quietly setting up one of the most asymmetric trading opportunities in the entire market right now. Before we go further, if you enjoy deep breakdowns like this one, do me a quick favor and hit that like button and subscribe. It genuinely helps the channel more than you know. All right, let's get into it. But to understand why the market is punishing this stock so brutally, we first have to understand exactly what IREN is trying to build. Here's the thing. IREN is aggressively trying to shed its past. Historically, this was a Bitcoin mining operation, which meant its legacy revenues were chained to wild, unpredictable crypto cycles. But right now, they are executing a massive vertically integrated pivot into AI cloud infrastructure. And they aren't just dipping their toes in the water. They are targeting an explosive expansion from 23,000 GPUs to an almost unbelievable 140,000 GPUs by the end of 2026. If they pull this off, they don't just survive. They transform from a volatile crypto play into a foundational AI infrastructure dominance story. And honestly, the early data suggests they might actually be pulling it off. On July 20th, IREN fundamentally rewrote its own valuation model. They announced locked-in, multi-year cloud services agreements worth $2.8 billion with three absolute heavyweights, Microsoft, Nvidia, and Perplexity. And this is the key part. This isn't speculative, hopeful, someday maybe revenue. These are contracted, signed, direct paths to a newly elevated $4 billion annualized run rate revenue target for 2026. They are trading unpredictable crypto mining rewards for sticky, contracted, multi-year enterprise cloud income. But before you get too bullish, there's another layer to this growth story, and it's pulling in some serious institutional attention. IREN was recently added to the Russell 1000 index. Now, why does that matter? Because index inclusion forces mandated, passive, algorithmic buying. It doesn't matter if retail sentiment is euphoric or terrified. Index funds have to buy this stock. They have no choice. And it gets more interesting. There's massive speculation swirling around their 800 megawatt campus in Australia. Reports recently surfaced that AI titan Anthropic is hunting for 1.4 gigawatts of data center capacity in that exact region through a 22 billion Australian dollar tender. When that news broke on July 6th, the stock jumped 13% in a single trading day. So could IREN quietly become the backbone powering the next generation of AI? It sounds almost too good to be true, doesn't it? And that's because there's a much darker side hiding underneath the hood. This is where the story gets complicated, and frankly, a little ugly. While the company is sprinting toward growth, its corporate governance has completely alienated a chunk of its investors. The board recently approved an $800 million compensation package for co-CEOs William and Daniel Roberts, handing them 18.2 million restricted stock units. And prominent short seller Jim Chanos publicly tore this decision apart, pointing out that this single, wildly dilutive package devours 17% of the company's projected adjusted net income all the way through 2030. Now combine that with a $50 million per year sponsorship deal with the Golden State Warriors, and suddenly institutional investors are downright terrified about cash burn right in the middle of one of the most capital-intensive build-outs you can imagine. And it's not just the spending that has Wall Street sweating. It's the sheer physical reality of what they've promised. Here's the uncomfortable truth. Despite that shiny $4 billion revenue target, roughly 15 to 41% of IREN's 2026 pipeline is entirely execution dependent and still uncontracted, meaning it hinges on the flawless, bottleneck-free delivery and installation of Nvidia GPUs, a supply chain that has burned countless companies before. Then throw in fresh fears that competitors like Meta Platforms could start renting out their own excess AI computing power, and you're suddenly staring at very real concerns about pricing compression across the entire neocloud sector. Which brings us to the one question investors actually care about right now. How is the market pricing this brutal contradiction. Massive contracts on one side, reckless spending on the other. The answer? The market punished them hard. Before the July 20th rebound, IREN sliced right below its key moving averages, completely losing both its 50-day and 200-day support structures. But, and this is important, look closely at the momentum metrics. The 14-day RSI plunged deep into oversold territory, hitting 30.58 on the daily chart and an extreme 25.8 on the hourly time frame. The negative MACD histogram confirmed that sellers had total, unchallenged control. This wasn't ordinary weakness. This was absolute, severe selling exhaustion. And here's where the story starts to get genuinely explosive. Because of all that governance drama, short sellers piled in with a vengeance. Short interest surged 37%, which means there are now 76.03 million shares sold short. Let that sink in. That's a staggering 22% of the total available float. On top of that, the 50-day put-to-call volume ratio is sitting at an astronomical 5.88, higher than 98% of all annual readings. This, my friends, is a textbook pressure cooker. And here's the beautiful part about pressure cookers. When you build up this much overwhelming downward force, any spark of positive fundamental momentum, like say a $2.8 billion contract announcement, can force these heavily leveraged bears to capitulate and frantically buy back the stock. But just how far down are these institutional bears actually willing to push it before they run out of ammunition? Believe it or not, we have a shockingly clear answer, and it's hiding right inside the options chain. Institutional market makers have established a heavily defended floor. Recently, an unusual block trade of 10,000 put contracts was executed at the $32 strike expiring on July 31st. This single trade carried a $1.42 million premium and generated a jaw-dropping volume-to-open interest ratio of 769. Translation? Deep-pocketed institutions are actively defending the low 30s, essentially drawing a hard, reliable line in the sand right there. So if the floor is locked in, the next question is obvious. Who on earth is actually accumulating shares down here at these beaten down levels? What we're witnessing is a massive institutional tug-of-war. Total institutional ownership remains robust at 41.08%. And while legacy holders like BNP Paribas and Morgan Stanley dumped over 7 million shares combined, the real heavyweights stepped in aggressively to buy the dip. Defiance ETF snapped up 12.67 million shares. And BlackRock, arguably the most powerful asset manager on the planet, increased its stake by over 600%, adding nearly 4 million shares. Though to be fair and keep this balanced, we did see some insider selling from director Christopher Gazowski, who offloaded roughly $434,000 worth of stock. But despite that insider sale, Wall Street as a whole is pointing overwhelmingly in one direction. The broader analyst consensus currently maintains a moderate buy rating with an average price target of $82.36. Now think about that for a second. That implies well over 100% upside from the current consolidation range. On the bullish end, you've got Bernstein standing firm with a $100 price target, built directly on the strength of that Microsoft pipeline. And on the bearish end, the most cautious outlook comes from JP Morgan at $46, citing those exact capitalization and execution risks we broke down earlier. Which brings us to the three critical pillars you absolutely must monitor if you're planning to hold this stock for the long haul. For IREN to actually grow into those massive valuations, three things have to go right, flawlessly. First up, hardware deployment. They must secure those coveted Nvidia Blackwell GPUs on schedule to hit their 140,000 unit target. No delays, no excuses. Second, customer diversification. They need to officially land that speculated Anthropic tender to reduce their heavy dependence on Microsoft alone. And third, debt management. IREN just secured a $3.65 billion GPU financing facility at a 6% blended rate. And they have to service that debt cleanly, without triggering any more toxic equity dilution that would punish existing shareholders. Which finally leads us to the big payoff, the part you've been waiting for. How do you actually trade this setup over the coming week? For the window running from July 20th through July 26th, the setup leans decisively long. The strategy here is to accumulate on intraday consolidation between $38.50 and $39.50. Your primary technical support sits between $36 and $37.70. That's the floor of the recent descending channel. But listen carefully, because discipline is everything here. Your hard stop loss must be set at $34. If you see a daily close below that level, the technical base is officially officially broken, and you risk a rapid slide right back down to that $32 options wall we uncovered earlier. But if that support holds, the upside targets become wildly asymmetric. Our first near-term algorithmic resistance sits at $42.72. But the real primary price target for this setup is $46.20. And here's what makes that number so fascinating. It's not just a significant double top resistance level. It also lines up almost perfectly with JP Morgan's bearish price target. So if IREN can smash through $46.20 on strong volume, it could trigger a deep systemic short squeeze as that 22% short interest scrambles desperately for the exits. Ultimately, while the governance overhangs are absolutely real and shouldn't be ignored, the fundamental validation of a $2.8 billion AI contract, combined with this extreme, historically rare level of options pessimism, creates a phenomenal, highly asymmetric setup for the sharp, disciplined trader. Now, before we wrap this up, I need to be crystal clear with you. Everything I've shared in this video is for educational and informational purposes only. I'm not a licensed financial advisor, and nothing here should be taken as personalized financial, investment, or trading advice. The stock market carries real risk, and you can absolutely lose money, including your entire investment. Price targets, forecasts, and setups are speculative by nature and can be completely wrong. Please always do your own thorough research and consult a qualified financial professional before making any investment decision. Never invest money you can't afford to lose. With that said, I want to hear from you. Here's my question for the comments. If IREN's management is spending $50 million a year sponsoring a basketball team while short sellers are screaming about dilution, is that a genuine red flag you'd walk away from, or just noise you'd happily ignore for a shot at that 100% upside? Drop your honest take below, because I read every single comment and I love hearing where you all land on these debates. And if this breakdown brought you value today, you already know what to do. Smash that like button, hit subscribe, and ring the notification bell so you never miss the next deep dive. Because in a market moving this fast, the traders who stay informed are the ones who stay ahead. I'll see you in the next one.